All right. Hey, everyone. Welcome to the Ultra High Net Worth Clients Podcast. I'm your host, Chris Broadhead. Today, we have the pleasure of talking with Bruce Weininger. Hey, Bruce, can you introduce yourself and tell us a little bit about you?
Hi, Chris. Thanks for having me. I'm a principal at Kovitz Investment Group, RIA firm based here in Chicago with about $7 billion under management. We work in the high net worth and ultra high net worth market, and that would be the quick overview anyway. I got a much longer one, but I think we've got limited time today.
Awesome. Yeah, we'll definitely dig in. So, you and I know each other. Are my dad and you are friends. You're neighbors in Park City, but you're predominantly located in Chicago. So, I want to start at the beginning. How did you get into this wild world of financial advising?
So in college, I knew I wanted to combine accounting and finance. I was an accounting major. I had a miserable second semester of senior year studying for the CPA exam, but thankfully got that behind me. And I started out in Arthur Andersen's financial services audit division. The idea is we were auditing banks, insurance companies, investment companies, private equity, and I thought that might be one way to do it. And it took me about a year to realize that whether you're auditing a bank or a widget company, it's still auditing and still not what I wanted to do for a living. So I did what they called a tax internship, where you basically went from audits busy season in January and February, where you're working 60 plus hours a week, right into the tax busy season. But Andersen had a group of their tax department. They called it the PFP, or Personal Financial Planning Division. And while it was still heavily tax focused, we got to work with people on things that were broader than taxes, combining the taxes, the investments, the retirement planning, estate planning, insurance, anything to do with the high net worth personal finances. And the light went on, and I kind of realized that's what I wanted to do for a living. So that's how I started it. It was a little bit of a winding road to get to Kovitz 20 years ago, but that's when I realized how I was going to use my accounting and tax skills in addition to the broader financial planning that we do.
Mm-hmm. Awesome. There's a lot to unpack there, but I think you are the second guest we've had who's both a CPA and a CFP. That's unique. A lot of the CFPs we have on, I'm like, how do you find clients? And they're like, oh, we're just close friends with a lot of CPAs. How is being a CPA? How has being both a CPA and a CFP impacted your career?
Yeah, so I've got some pretty strong biases about that, in the sense that there are lots of, financial advisor is kind of a very it can mean lots of different things. It can be people that are really 90% on the business development side and they're calling themselves a financial advisor, or an insurance agent that's calling themselves a financial advisor. And then you've got the other end of the spectrum, which we try to play in. And in that regard, we really think like I said, there are financial advisors, there are great investment advisors, and then there's what I'll call most trusted advisors. And to be a most trusted advisor, you've got to have a broader skill set than just the investments, in our opinion. You've really got to understand how the investments fit with retirement planning, fit with estate planning, and taxes are an overlay to all those things. So by no means are all of our advisors CPAs or attorneys, in addition to CFPs, although some are. But the taxes and the estate planning are the hardest thing to teach people, and we really want our advisors to be well-rounded in those areas as well. So I think it's really helped in terms of being able to be that first phone call on anything related to a client's personal finances, not just just the investment guy. And I don't want to downplay the importance of being solid on the investments, but we want our advisors to be more well-rounded, and certainly the tax knowledge, both income tax and estate tax knowledge that I got as part of the CPA process and spending a number of years at accounting firms, I think have really, really helped.
Mhm. So it sounds like it adds a lot of value to your clients. They're like, I can ask you investment questions. I can ask you how those investment questions will affect my taxes and my assets. So it's you're a day walker, if you will.
Yeah, day walker. I hadn't heard that term before, but I guess I'll take it. But yeah, I mean, things like Roth conversions are a good example of something that if you understand kind of how taxes work, you can try to figure out when they make sense. We found that they're grossly underutilized as compared to the people that could benefit from them. And we don't know if it's just a lack of comfort on advisors with the whole tax idea, and when paying tax, especially if you can do it at lower rates, makes sense. Or if I wanted to be cynical, I would say that, there's some advisors that look at the fact that, well, if we convert the Roth, we're going to have to pay taxes and I'm going to lose assets under management. But the point of being an RIA rather than a broker dealer or a big bank is that, we're held to that fiduciary standard, and we need to put the client's interest first. And to do that, you've got to be willing to bring them ideas, even if in theory it's not in our best interest. But and I would argue it is in our best interest, because if you look at some clients that did Roth conversions 10, 15 years ago, one of the schedules we showed them at every meeting is how much they converted and paid tax on at the time and how much it's worth now. And we've got clients with $1 million, $1.5 million, $2 million of appreciation above and beyond what was converted to Roth. That's never going to be taxed. And you do build some goodwill up when you show that to them at every meeting.
Mm-hmm. Awesome. That they must appreciate all the cutting edge insights there. Are there any fun, creative, or new ways that you are helping your clients, normal clients, high net worth, ultra high net worth clients, save money on taxes?
And the ultra high net worth clients, I think what a lot of people miss, especially on the financial advisor side, is the best way to add value is to help with estate planning, because every day, for the 20 or 25% of our clients that are estate taxable, and it could be a lot higher than that 3 years from now when the tax code, the current tax $12 million person tax exemption basically gets cut in half. What people miss is that every dollar you can get out of their estate is a 40% return on investment. And I mean, I don't know how good the other people you're talking to are on the investment side, but we're not walking around promising 40% returns. In fact, I can almost promise we're not going to earn that. and yet every dollar we can get out of the estate is the equivalent of a 40% return on investment. So for our ultra high net worth clients, we spend just as much time on the estate planning piece, maybe even more than we do on the investment piece.
Mm-hmm. Just because it's such a higher ROI.
Yep. And that's what they're paying us for, right? I mean, they're not paying us for our winning personalities. They're paying us for the ROI.
Wow. And how do you reach that 40% return?
Well, literally, the estate tax is 40%.
It is 40%.
So it's just a matter of if any asset you can move from a pot that's in their estate to a pot that's out of their estate, and that can be, utilizing annual gift exclusions. It could be grant or retained annuity trusts. It could be qualified personal residence trusts. It could be what's known as a SLAT, or a spousal lifetime access trust, where you take full advantage of the $12 million exemption today. And even if they do lower it at that point, that 12 million is out of your estate. And most importantly, the growth on it's out of your estate. So when I say 40% return on investment, I mean, literally, if you can get, for every dollar you can remove from a client's estate, it is a 40%, you save them 40%.
Wow.
But part of that, and this gets back to the kind of pulling together the investments, the retirement planning, estate planning, you're not going to be successful getting clients to give up control of assets, because in one way or shape or form, usually that's what it involves to get it out of your estate, unless you can convince them that they have enough in their estate based on their spending and their lifestyle, that they're not going to need those assets. So, you've got to get them to the point that they're comfortable that they have more assets than they need. And even clients with 25, 50, 75, $100 million, depending on their lifestyle and what they're spending, you'd be surprised that, some of them need some convincing that they're not going to wish they have those assets back.
Mm-hmm. So the assets go to a place where they're safe and they're not taxed at 40%, but they're not easily accessed.
Yeah, they can't. Again, with something like a spousal lifetime access trust, you can set it up so that your spouse can get assets if they need it. But if the spouse dies or you get a divorce, you no longer have access to those assets. They'll be for your kids or grandkids, or depending on how you set it up. But right, if the IRS's position in very general terms is if you own or control those assets, they're going to be included in your estate. So it will usually involve some form of gifting to a trust that you have limited amounts of control to and access to. And what we tell clients is we've never had an original estate planning idea in our lives, but we've had we've been able to work with some of the best estate planning attorneys all over the country. We've got clients in 50 states, and we're very good at appropriating other people's ideas. So while we don't draft documents, we can bring up ways that we know and tricks in terms of how much flexibility can you add to those trusts without crossing the line where the IRS is going to be able to pull them back into your estate. But we absolutely positively need to partner with good estate planning attorneys in order to draft the documents and implement the ideas.
Mm-hmm. And good estate attorneys are the key way to make sure that you don't cross any lines with the IRS.
Yeah. And we joke that we're not estate planning attorneys. We just play them on TV.
That's awesome. So I want to take another step back. So when it sounds like you're working with a lot of sizable clients, a lot of ultra high net worth clients. When you were first starting out and building your practice, did you have a specific focus? Was there a certain type of client that you wanted to work with, that you were looking to work with, and how did that evolve?
Yeah, so it evolved through I'll say 3 jobs, not including the 2+ years I spent at Arthur Andersen. But I left Andersen, went to a firm called ACO, which is now wholly owned subsidiary of Goldman Sachs. And their niche was they worked with Fortune 500 companies, would hire them to work with their senior executive group on their personal finances. The theory being they were spending 60, 70 hours a week on their jobs, and either they were totally neglecting their personal finances, which was the case much of the time, or they were spending time on their personal finances to the detriment of what they were being paid to do, which was run the business. Mm-hmm. So at ACO, we had about 1/3 of the Fortune 500 companies as clients. And, after spending time working for some very good people, I got promoted to the point that when we got new corporate accounts or people retired, I became the lead advisor. So my book of business initially was almost all corporate executives. It could be, many of them, I don't know if it was most of them, but many of them were C-suite executives, top, CFOs, CEOs, of Fortune 500 companies, but the rest of them were kind of one notch below. When I left ACO, I went to Deloitte, back to public accounting to run what they call their Midwest private client practice, and essentially try to convert the mindset of the accountants from billing hourly to you have to have a flat fee so that people will call you with questions, not, I'm going to tell you about it after the fact because I don't want to get a bill for X hundreds of dollars every time I call you. And the whole mindset of proactively setting up meetings with clients, not waiting for them to call because you're getting an annual retainer to do the work. And when I went to Deloitte, it was a little bit of eye-opening because you realize that a decent amount of their practice, they still had a lot of senior executives, but a lot of the wealthiest clients own their own businesses, and the amount of wealth from private business owners, and they also had some that was inherited wealth, but family office type clients. It just expanded the types of clients I was working with, but it was still either very senior executive or ultra high net worth. When I got to Kovitz, I joked for the first time that we were able to work with mere mortals, meaning our minimum relationship was a hard $1 million, but there are a heck of a lot more of those people than there were the $100 million clients. So while we are, I think our median client is somewhere around 3 million as a firm. Mine's probably somewhere between 5 and 10. On an average basis, it's much higher because it's skewed by a number of $100 million plus clients as well. So that's kind of trying to get back to the original question, but how you was the question kind of how I went about getting clients, or was it something different? You got to come back and help me because I've gone on a long journey here. Bring me back, Chris. Bring me back.
Yeah. It was, how did you get started working with ultra high net worth clients?
That was how. So it was, at ACO, certain clients are handed to you, but our role was, if there were, 40 eligible clients at General Motors and we had 12 of them, the goal was to get referrals from those clients to the other ones that weren't taking advantage of the service. Or as we did at a number of corporations where we start working with the top 5, they might expand it to their direct reports or make more executives eligible for the service. So that was kind of how I got clients there. At Deloitte, it was different. It was more about, you had lots of partners that had relationships with key people, and a lot of it was internal. And at Kovitz, it's almost all referrals from existing clients. That's how we've grown our business. I think there are you said it before, there are a lot of people in our business who will try to focus on centers of influence, the accountants, the attorneys. But to us, there's no better referral than someone saying, I work with these people, and so should you, as opposed to an accountant saying, here's 3 investment advisors some of my clients work with, but I don't happen to work with any of them personally. So the vast majority of our clients at Kovitz have come from referrals from existing clients. And there, as you probably gathered by talking to other people, there are lots of ways to grow businesses, ranging from, cold calls to seminars to networking, to building relationships with centers of influence. But for us, it's been about service your clients really well and ask for referrals. I still remember sitting down with someone at one of the wirehouses. This had to be 20 or 25 years ago, and he told me about their 80-20 rule. And most of us know the real 80-20 rule, but in their case, it was they wanted their management wanted them spending 80% of their time looking for new business and 20% servicing existing business. And that is so ass backwards from our perspective. We'd rather do a great job servicing clients and mention remind them at the end of the meeting that the only way we grow our business is referrals. So they think of us when they hear about someone bitching about their current investment relationship.
Mm-hmm. Yeah, that makes total sense. So for ACO, you're working there. How did they establish the relationships with the big companies full of C-suite executives?
Okay, so The short version is executives are mobile. So if we're working with a senior vice president at Textron and they become the CEO of another company, their choice at that point is to pay out of pocket for us or to introduce us to their HR people. So now we have a program at the new company that senior vice president is the CEO of. The other part of the marketing plan was a lot of these CEOs and other executives sit on boards of other companies. And if you can get an introduction from the board level to the HR level to the HR person, that also works well. But I can't speak to, it's been 25 years since I left ACO. Their business model could have changed a bit, but 25 years ago, they had over a third of the Fortune 500 companies as clients. So they've got a nice niche.
Wow. So that's very unique. I've not heard that yet from any of our guests. You basically cut your teeth with ultra high net worth clients.
Right. I was in my late 20s when I was in my late 20s, early 30s. I was working with 4 or 5 Fortune 500 CEOs. It was baptism by fire.
Yeah. Just jumping into the deepest end there, Bruce.
Right. But what I will tell people, and it was, I remember, again, I'm a proud graduate of the University of Illinois in Champaign, and they have a very good accounting program. But I remember looking, and there were people with just a different level of mental horsepower than I had in some of those classes. But within 2 or 3 or 4 years out of college, the people that you would have expected to be superstars weren't necessarily, 3 steps ahead of everyone else, and people that you would have thought would have been typical were doing great. And the one thing that I noticed is that, and I suspect this is true in a lot of professions, you'd rather be in the 80th percentile of technical skills and 80th percentile of communication skills than being in the 99th percentile of kind of technical / mental horsepower. What I was surprised at is it's not always about what you know, but in a business like ours, it's about how you can communicate it to people and how you can persuade people to act in their best interest as opposed to making this a lower priority for them. And having some combination of decent communication skills and decent technical skills is much more important than being in that 99th percent of either of those things. And I think if we're speaking to a younger person, it's spend time getting good at both of them versus feeling like being great at one is going to get you as far, because I don't think it will get you as far.
Mm-hmm. Mm-hmm. Yeah, well balanced across the board, being able to understand the mechanics and explain it, I think is what you're saying. Yeah, awesome. So going from ACO to Deloitte to Kovitz, were you able to bring your book of business with you across businesses, or how did that work?
Yeah, so the ACO to Deloitte is a much longer story, and that was not necessarily a pretty transition, though it worked out just fine in the long run. Deloitte, the transition to Deloitte couldn't have gone smoother. I can't say enough about that organization, but the short version was, they were, when I went to Kovitz, we were strictly an investment firm, and we really did not build out the broader financial planning practice until a number of years later. And they were great about allowing me to talk to my clients about Kovitz's investment work. And I spent a number of months doing my best to transition my relationships on the tax side and kind of broader financial planning side to other people that were at Deloitte. And they're still partners there at Deloitte that I'm still close to, that happen to be clients here on the investment side. And can't say enough about how how fair they were throughout the transition process. Could say a lot about Acre's transition process, but I won't.
Well, we'll take the high road today. So, wait, you mentioned referrals previously, and I'm always curious. Do you have a specific strategy for asking current clients for a referral?
Um, uh, so I would say no, other than you just have to remember to ask. I mean, so many people, for whatever reason, aren't comfortable for asking for referrals. And I've found that if you're confident that you're adding value and adding value in excess of your fees and you feel good about the relationship, it should be totally natural to ask for referrals. And again, we've been able, without any advertisements, without any free seminars, without any cold calling, I think we were 400 million or so under management in 2004 when Kovitz launched. Most of the other guys were part of Rothschild, and I parachuted in 6 months later to run the client side of the business. But we were probably 400 million, and today we're 7 billion. So I think there's something to be said for doing a great job servicing your clients and then ask.
Mhm. Yeah, simple as that. Just ask.
It doesn't have to be. I mean, again, there are lots of people that have more sophisticated ways of doing it, and they may be more effective than what we've done it. But we've looked for people that are good client service people, and in hoping that the business development piece follows. There are a lot of other organizations that have been built by focusing on business development people and having just, adequate client service.
Mm-hmm.
So we prefer the former model.
Mm-hmm. Awesome. And I noticed on your LinkedIn that you've been the primary source of financial advice to more than a dozen Fortune 500 CEOs and CFOs. Could you share with us what their most pressing concerns are lately?
Yeah, I won't say lately because, like I said, my business has evolved over the last 20 years, but their most pressing concern was their time, to be totally honest. And anything we can do to make sure that their personal financial affairs were in order, whether it's not missing a stock option exercise or whether it's making sure their estate plans are set up so that their family's taken care of, whether they have the right amount of life insurance if something were to happen to them, although thankfully you don't sell life insurance. How to fund their grandkids, their kids or grandkids' educations. They're not they're very organized. They're very good at time management. And the big surprise to me in working with CEO level executives was their people skills are so damn good. There are a lot of very good there are a lot of very good technicians in the world, but the thing that set the CEOs apart was they were great communicators. And the one thing that it was interesting, they came at it from a totally different view at Kovitz, but at Kovitz, we're value managers, Buffett, Graham and Dodd kind of approach, but the investment team here really didn't want to meet with management. They would read all the transcripts of the earnings calls. They would, most of them are CPAs or CFAs. They could comb through 10Ks with the best of them, but CEOs are really good at selling their story. They believe in their story. They always believe their stock is undervalued. And from my perspective, I saw that when I would talk to them about usually the very much concentration risk they had in their company stock. Sometimes it was mandated by the board. But when I joined Kovitz, they, for different reasons, had reached the same conclusion that I don't want to let the personality and their great communication skills sell me on their stock. I want to know what the numbers tell me. And we were, I think we are still an outlier in generally not wanting to meet face to face with management in the companies we own because they are so good at persuasion.
Mhm. Yeah, you get sucked into their, charisma,
Yeah.
personality.
And it's what helped get them there. And I don't mean that in a negative way in any way, shape, or form, because I don't think I worked with one CEO that really didn't believe that their company or their stock wasn't underappreciated.
Mhm,
Um, but forgetting their talking about their own company, their own stock aside, um, uh, they, as a group, I think what stood apart is that they had great people skills.
mhm. Any advice for advisors who may be on the precipice of working with very influential, charismatic clients?
Yeah, I mean, I don't know specifically that, but advice for younger advisors. What we tell our people here is hopefully early in your career, you're going to have the chance to interact with a number of different more senior advisors. And if they've been reasonably successful, chances are they have at least one trait that is very, very good. And as a younger advisor, your goal ought to be to discard the 9 things you might not like about your boss, but find the one that you do. And in over a period of years where you have a chance to interact with people, build your practice and your attributes around taking the best things from different people you work with. I mean, sitting here 35 plus years in the business, I can still tell you that, that first day that that I was trying to figure out what the hell estate planning was, and I didn't know what a two-share estate plan was. And there was a senior manager at Arthur Andersen that called me into his office, brought me up to his whiteboard and started drawing with this enthusiasm about, this is why how two-share estate plans work. You get to double your exemption. You can still have flexibility to get in assets if you need them. And his enthusiasm was infectious. And having sat in our meetings with him over the years, he was the same way when dealing with clients. This is why this is important. This is why you ought to pay attention to it. See what we can do. And so from that guy, his name was Art Cohen, by the way. I tried to incorporate more than an accountant's personality when talking about some of the planning techniques. There was another guy I had the chance to work for, just retired, a guy named Alan Chesky, who was so organized. He had such systems in place where nothing fell through the cracks. He was a really clear communicator in terms of the meetings themselves and the follow-up. Every meeting was documented with a follow-up letter, which is also unique in this business, where we told him what we summarized what we told him. We told them what we're going to do as follow-up. We reiterated what they owe us. If they've got an outside 401k statement we need for the asset allocation chart, or they needed to check a beneficiary of a life insurance policy, get something in writing. It was all there and really organized. And I tried to incorporate that. And there was another advisor at ACO that he would always put the client's interest first. And that was his mantra. And today at Kovitz, when we log on to our screen every day, the very first thing, we see in terms of our 4 principles, the first one is clients first. And that was probably the third major thing that I was able to take from different people over the course of the first 5 or 10 years of my career. And even if younger people are not in the perfect job for them or in the perfect situation, they could spend those first 5 or 10 years looking for the best attributes of people they've worked for and kind of make it their mission to incorporate that into the way they want to be as a profession.
That's awesome advice. Thank you for sharing that. So, we're coming to the end of our time. I know you're a busy person, wanna respect your time. My next question. So I know you work with a lot of ultra high net worth clients. Are they asking any interesting questions lately?
Are they asking any interesting questions? Boy, that is a good question. I'm trying to think if I could think of a pattern. For many of the younger clients, this is the first time they've seen interest rates as high as they have, and people that would be disparaging when we would tell them that they needed at least 20% of their assets in bonds, and for a lot of clients, it's higher than that. They'd roll their eyes, and now they're getting a little bit more excited about the idea of some fixed income. I would say I've had a number of people, especially those in Chicago and other big cities, express concerns around looking around their downtown areas and seeing occupancy at 50% of 2019 levels and wondering how that's going to affect the big cities and the banks and others that have lent to the owners of office buildings in the big cities. So certainly heard our share of that. And the other concern is obviously the polarization we see in DC and if in fact they can't get anything done over the next 3 years, what the tax increases that would then go into effect in 2026 would mean to them, both on the income tax side and the estate tax side of things. So that's what I hear them in terms of being concerned or asking questions about, but I'm not sure I have a theme in terms of, unusually interesting questions. Have to think about it. And it doesn't sound like we got enough time for that right now.
No, that was a great answer. I also have concerns about the empty commercial real estate. As a millennial who doesn't currently own any property, and I'm told, oh, there's a shortage of supply. That's why it's quadruple the price it was 20 years ago. I'm like, okay, well, why can't we just convert all this empty commercial real estate into more reasonably priced real estate?
Yeah, and I think you're gonna see some of that. Although the other things I've read on the topic, and it's not my area of expertise, is that it's much more expensive than you might think to convert a high-rise office building to apartments. But my guess is someone's gonna figure out how to do that, because having the downtowns of our major cities half utilized is not the long-term answer. Chicago on Mondays and Fridays, down in the Loop area where I'm in right now, is like a ghost town.
Wow, that must be surreal.
Yeah. Well, anyway, the Loop looks like when I say ghost town, it looks like it looks on a Saturday or Sunday.
Wow.
In terms of just the lack of traffic, but that makes it really hard for restaurants and other things, for people in the office 3 days a week to make it. And that's, I don't think that's unique to Chicago. I think it's true in most major cities right now.
Mm-hmm. Yeah, I think so as well. Awesome. All right. 2 more questions, and then I will set you free, Bruce.
Okay.
Are we in a recession, going into recession, or are we on our way out of a recession?
And my answer is who cares? And I don't mean that disparagingly. I just mean that, you can see people there. All you do is turn on the TV and flip channels, and you will have 100 opinions to that. 100 people will give you their opinions to that answer. And it's not that we don't have opinions on that. It's just that we don't think our opinions are any better than anyone else's. And our investment approach is very much bottom up, not bottoms up, but bottom up, where we're trying to value businesses, and we're going to make reasonable assumptions about long-term growth rates through different cycles. But we think it's a lot less sexy at cocktail parties to talk about what's the value, what's the value of Apple, or what's the value of CarMax. than it is to talk about, which way are interest rates going? Are we headed to a recession? The lack of supply in housing, the the oversupply of office buildings. But it's much, much harder to do it the way the other 90% do it, which is this top-down way where you try to get the economy right, then you try to say what sectors are going to benefit, then you try to pick the winners within the sector. The idea makes perfect sense, but you've got to get three things right to be a successful investor there. Whereas if our view is not to believe that we're better than anyone else at making the big macro calls, but try to focus on good businesses that are out of favor for one reason or another. We joke that only compared to economists, only weathermen could be more often wrong and still keep their jobs. So you can find lots of opinions on the macro issues, but it's not something we spend a lot of time thinking about. But if you ask, are we in a recession? No. Have we been in a recession in the last 2 years? No. But so it's easy to look backwards. But if you ask me what's going to happen 6 or 12 or 18 months from now, the only thing I'm sure of is that my opinion is no better than anyone else's.
That's a great answer there, Bruce. Awesome. Final question, and it's an open-ended question. You can take it in any direction you like. The question is, what are you working towards?
I am working towards retirement.
Amen.
You asked, and so I've been, but honestly, when you get to this stage, I've been doing this. I'll be 60 in April. For the last 7 or 8 years, I've been working because I want to, not because I have to. And the thing that I'm probably most proud of at this stage of my career is that through hiring, training, and some other things, there are 7 or 8 really, really good partners or senior advisors here that I feel really good about handing clients to, and I've been doing that for 3 or 4 or 5 years now. And at this point, the only clients I'm working with is probably 40 or 50 still. The majority of them are people that have been with me for 30 years, that have followed me through 3 jobs. And I feel like I owe them, and I would feel really, really bad if I didn't have somebody that I knew would do as good a job as I feel like I've tried to do for them. And so the developing of younger talent, it has been, if you'd asked me what I've been working for the last 5 years or even 10 years, that makes me feel really good that those clients that have been with me for so long are going to be well serviced as I gradually continue to cut back my workload over the next 2, 3, 4, 5 years.
Mm-hmm. And you're keeping it all in-house within Kovitz?
That's the goal. Yes, that's the goal. Again, there are probably, I don't know, 8, 9, 10 people that at some point in my career, I've had the opportunity to work with that have just become superstars in this. And at least I think 7 of the 9 are still here at Kovitz. One was somebody I worked with at ACO that's still at ACO, and a second was someone I worked with at Deloitte that's now at Goldman. But there are a couple others that come to mind now. I don't want to sell them short, but a number of them are people that are homegrown or people that joined Kovitz, 10, 15 years ago. Some of them probably close to 20 years ago now, who are just thriving. And again, that makes me feel really good.
Mm-hmm. Awesome. What's the plan post retirement?
To go biking with your dad. So it's much of the same. My wife and I had always planned, when our youngest went to college, to buy a place in Park City, Utah, which is where I met your dad. we're gradually transitioning to spend more time there. The one thing about COVID is that my remaining clients got very used to Zoom. And so as a financial advisor, especially an experienced one where you've been face to face with them for 20 or 30 years. At this point, most people are satisfied with mostly Zoom meetings. So it's, one thing I'll say about our profession, once you get past the early years of your career, it affords you a lot more flexibility in the back end of your career to work from where you want. And I'm thankful for that.
That's awesome. Yeah. And in 5 years, you won't even get yelled at for having an e-bike on the trails.
That I'll just say that's true. That's a discussion that goes on a lot in Park City, Utah, the whole e-bike discussions. But we've got regular mountain bikes and we've got e-mountain bikes, because without the e-mountain bikes, I couldn't keep up with my son. And so my wife and I have both the regular and the e-mountain bikes, but I'm sticking with the analog road bike. The road bike is still the pure one. So
nice. Staying strong up there. Love it. Love hearing it. Awesome. And where can our audience find out more about you, Bruce?
Kovitz Investment Group is the name of our firm. We have a website. It's www.kovitz.com, and both me and the other 75 or 80 Kovitz employees profiles are up there.
Awesome. We'll be sure to link to those in the show notes. Bruce, thank you so much for taking the time to talk with us. This was fascinating. I could have asked you questions for the rest of the afternoon. I will see you in Park City, hopefully sooner rather than later.
Okay. All right, Chris. Thank you. Thanks for having me.
All right. Awesome. And to all the listeners out there, thanks so much for tuning in. We will see y'all next time. Keep on growing out there, everybody. See you.